Today, if someone were to tell you to invest in the S&P 500, would you know what to invest in and how? Here's where a lot of beginners get confused, because once you decide to invest in the S&P 500, you suddenly discover there are a dozen ways to do it. There are cap-weighted ETFs like VOO, SPY or SPYM, or IVV. You've probably heard of these. There are mutual funds like Fidelity's FXAIX, Schwab's SWPPX, or Vanguard's VFIAX. And then you have value-weighted ETFs like SPYV, IVE, and VOOV. And then you have equal-weighted funds like Invesco's RSP. And now I know you're wondering, are all of these the same thing? Well, mostly, but not exactly the same. Different returns based on different ways of valuing the top 500 publicly traded companies in the US stock market. So in this video, I'm going to show you how to invest in the S&P 500, explain the differences between the most popular funds, and show you one fund that most investors don't know about. Now, before we talk about fund, let's talk about what the S&P 500 actually is. The S&P 500 is an index made up of approximately 500 of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, Meta, Berkshire Hathaway, and hundreds of others. So when you hear people say the market went up today, they're often talking about the S&P 500. And historically, the S&P 500 have averaged roughly 8 to 12% annual returns over long periods, which is why people often recommend this investment. Now, here's something important. You can't actually buy the S&P 500 itself. It's just an index. Instead, you buy a fund that tracks the index. One of the benefits of investing in this index is that it undergoes a quarterly rebalancing. So I'll quote an excerpt from the CME Group to better help you understand what this process is and why it happened. The primary goal of rebalancing is to ensure the index remains relevant and accurate representation of the current market. By making timely adjustments, the S&P 500 reflects the changing US economy and aligns with quarterly financial results. Rebalancing is essential to prevent any single company or sector from exerting a disproportionate influence on the index's performance. If a company no longer meets the inclusion criteria, it is removed and replaced. These criteria include a qualifying market capitalization and also require that a company's earnings be positive in the most recent quarter and for the past 4 quarters, among other requirements. This shows that when you invest in this index fund, it is consistently rebalancing to accurately benefit us investors by making sure that we aren't investing in companies showing a consistent downward trend. Here's where most beginners get confused. You'll hear people talk about the funds that I mentioned earlier, and they all track the same S&P 500 index. So why are there multiple versions? Well, because different companies create funds that follow the same index. Think about it like this. Imagine 5 restaurants all selling a cheeseburger. The cheeseburger is the S&P 500. The restaurant is the fund company like Vanguard, Fidelity, Schwab, State Street, BlackRock, whatever. The product is basically identical, but the price and structure might be slightly different. So let's go over some of the top funds and I'll show you how they differ. Now let's start with one of the most popular options, VOO. VOO is the Vanguard S&P 500 ETF. It tracks the S&P 500 using market cap weighting. That means larger companies receive larger allocations within the fund. Apple and Microsoft have more influence than smaller companies. VOO has become incredibly popular because of its low expense ratio of around 0.03%. For long-term investors, that's a huge advantage. The lower your fees, the more money stays invested. Now, it being an ETF means it trades like a stock where you could see the live updates throughout the day. There are other options that are cheaper though, so you'll see them here in a bit. Next is SPY from State Street. SPY was actually the first S&P 500 ETF ever created. It tracks the same index as VOO. The holdings are nearly identical. The biggest difference is cost. SPY typically charges a higher expense ratio of 0.0945% or 3 times the cost of VOO. So then you would wonder, why would people still buy it? Well, SPY is one of the most heavily traded ETFs in the world. So for active traders, that matters. According to Forbes, it holds many benefits like extended hours trading, efficient pricing for retail trading, options trading. Now, for beginners and long-term investors, that doesn't really help nearly as much. That's where SPYM comes in. SPYM is a cheaper version of SPY with an expense ratio of just 0.02%, so less than VOO. Now let's talk about my favorite option for my Fidelity investors, FXAIX. This is Fidelity's S&P 500 index fund. Now instead of an ETF, it is a mutual fund. And if you are investing through Fidelity, this is often one of the simplest choices. It also has an incredibly low expense ratio of 0.015%. So for beginners using a Roth IRA at Fidelity, FXAIX is often a very straightforward choice. And I personally hold it within my Roth IRA. Charles Schwab has a great article explaining the difference in these weighing methods, and I'll link it down below. I'll quickly cover just a few keynotes from the article. The S&P 500 tracks the performance of 500 the largest companies in the US by size, as measured by their market capitalization. Now, market cap is the company's total stock market value calculated by multiplying its stock price by the number of shares issued by the company. Simple multiplication. Now, the bigger a company's market cap or valuation is, the larger its footprint or representation in the index. Now, value-weighted, also known as fundamentally weighted indexes, measure stocks for inclusion in the index based on a company's economic size. We are talking operating cash flow. The amount of cash a company keeps after covering all of its expenses reflects the actual cash available to reinvest in the business. Dividends and buybacks. Dividends are earnings distributed to shareholders, and buybacks are shares a company repurchases to help them return capital to shareholders without triggering taxes. And then you have sales, a measure of the money a company receives for goods and services sold. Fundamentally weighted indexes offer a different lens on the stock market. Instead of looking at stock prices, fundamentally weighted indexes measure companies based on their actual economic footprint. Now, if this sounds like it's more your speed, let's cover a few funds that you can actually invest in. State Street's SPYV tracks the S&P 500 using the value weighting method. As you can see from the composition tab here in Fidelity, the top 10 holdings only make up 24.5% of the fund rather than the near 40% in SPY. The expense ratio is 0.04%, while the performance of the last 10 years is 11.96%. So not bad. So the iShares fund, IVE, is very similar to SPYV, and the top 10 holdings also hold 24.5% of the fund's portfolio. Now, the expense ratio of this fund is 0.18%, while the performance of the fund the last 10 years is 11.31%. Vanguard's S&P 500 Value Fund, VOOV, is very similar to SPYV and IVE, with the top 10 holdings also making up 24.5% of the fund's portfolio. The expense ratio of this fund is 0.07%, while the performance of the fund the last 10 years has been 11.89%. So not horrible for any of these. Now we'll cover how all of these funds compare side by side later in the video, but I want to show you one special fund first. Now let's talk about something most beginner videos don't cover: equal weight funds. Like we've covered, most S&P funds use market cap weight. The larger the company, the more influence it has. It makes sense in some ways. But like we've seen, the top 10 companies take up a large percentage of market cap weighted funds like VOO or SPY, nearly 50%. Some investors love this, as these large companies have a track record of generating income and growth. Now, other investors think it's too concentrated and doesn't really have the diversity that we think about in an index. That's where RSP comes in. RSP is Invesco's S&P 500 equal weight ETF. Instead of giving the large companies a massive allocation and smaller companies tiny allocations, RSP gets each company roughly the same weight. That means Apple gets roughly the same allocation as much as a smaller S&P 500 company like GoDaddy. This results in less concentration and more diversification. Now let's look at this graph comparing all of these funds. If you look at the graph, you can see similar patterns in these funds. The purple line shows the market cap related fund returns, the yellow line shows the value weighted funds, and the red line is the equal weighted fund, RSP. So you could see the peaks and troughs of the value and equal weighted funds are less extreme or volatile, but also lead to lower returns over the long term. Now for me, I have a long time horizon until I retire, and I'm still leaning towards a market cap weighted fund, as its total performance over time has been shown to be better. But RSP is an interesting option to know about if you're worried about diversification and more stable results. So how do you get started? Well, step one, open an investment account in a brokerage of your choosing. That could be a a Roth IRA, a traditional IRA, or a regular brokerage account. And if you don't already have any of these accounts set up, I've created a step-by-step tutorial showing exactly how to open them up through Fidelity if you want to use them. So I'll leave links down to those videos down below in the description. Step 2, you need to fund the account by transferring money from your bank account to the investment account. Step 3, choose your fund. This is where you would choose which fund that you want to invest in. One of the reasons I like using Fidelity is that they have all the choices. You can even invest in FXAIX inside of a Fidelity Health Savings account if you want. And step 4, this is optional but recommended, set up automatic contributions. This is where most wealth gets built, not from spending hours and hours researching companies' earnings reports and projections and picking the most perfect fund, but from consistently investing over time. Dollar cost averaging has historically been one of the simplest ways for beginners to build wealth. Now, if you're brand new, I wouldn't spend weeks debating between VOO or FXAIX or obsessing over whether RSP might outperform next year. The biggest factor in your success probably won't be the fund you choose. It'll be how much and how consistently you invest and how long you stay invested. At the end of the day, investing in the S&P 500 is one of the simplest ways to participate in the growth of some of the largest companies in the United States. You don't need to pick winning stocks. You don't need to watch the market every day. And you definitely don't need to be a financial expert. You just need to decide to start. Choose your low-cost fund and consistently invest over time. That's it. Now, if you're looking for help building your budget or a financial roadmap to open up rooms so that you can invest more, I offer one-on-one coaching and I'd be happy to help. For our YouTube audience, we offer a 50% discount if you use the promo code SHIELDLINE at checkout at the link down below. And if you found this video helpful, hit that like button, subscribe to the channel, and I'll see you in the next video.